creates unusual relationships that perhaps people, if they're not aware of, it can run them over. And this, when you're dealing in these unusual times, things aren't behaving the way that they historically might have behaved. So if you're backtesting strategies, perhaps they're not as applicable today as they were maybe 2-3 years ago. So I think that is the biggest risk that we're seeing at the moment, is understanding how to deal with more unusual times and times where there is more volatility than perhaps would be if you're using historical data.
Fadi, I would like to hear from you what you think is the greatest risk that traders face right now.
Actually, the risk continued like what when it started a few years ago, and it's never changed again. What I mean that there is always rules for risk management. As long as you are following these rules, you are regardless of the volatility, it will make you change, or let's say resizing your lot standard, for example, when there is high volatility or ATR and lowest. But rules is rules. I keep telling my followers that as long as you have the golden rules and you are working and you are applying those rules, you will never have losses. You will have some losses, but you will never lose your accounts. And that's the rule from day one when you are trading Forex.
Raja, are you seeing more volatility in the markets? And what do you see as some of the problems that traders are facing?
Definitely, like if we look at, let's say, gold, like gold is the most widely traded instrument at this point now. So if you look at gold, let's say like maybe from like 2 years ago, 3 years ago, you would notice that a 15 to 30 minute candle would be like maybe like 20 pips, 30 pips. But now with what's going on in the market, you're seeing a 30 minute candle move like 40, 50 pips. Right? So when you have all this volatility, traders think that they can trade the same volume size as they were 2 years ago. They can do that now. But if you're trading, let's say, a one lot on gold on a 15 minute candle, then you don't know, you're gonna go in like a 30 pip drawdown like that. So volatility is great to make money at the same time, but also when you have this much volatility in instruments like gold, indices, like even NASDAQ, right? So you have to make sure that you're managing risk at the same time to make sure that with volatility, you don't go into deeper drawdown than what you expected.
Let me add one thing. Let me say that volatility is like fire. As long as you are controlling it, you're on the safe side. But if you are not controlling that volatility, it will be devastating. That's as simple as it is.
Well, I do have a follow-up question to that, but let me first ask Marios. In your at your firm, in your environment, are you seeing traders being able to adapt to this volatility, or are you seeing that they're suffering as a result of the uncertainty?
Well, good question. Actually, yeah, I do agree about the volatility being the main risk taker in this scenario. Followers will, clients and partners will find an opportunity to trade on the volatility. So at our company, we create a risk-aware culture to ensure that internally and then externally, this is understood correctly. So we do need to have real-time reporting systems. We need to create a behavioral culture that can avoid these risks when volatility comes.
You just mentioned that you create a behavioral culture to avoid the volatility when it comes. Can you explain that a little bit more? What does that mean?
It is mostly a risk-aware culture. So the risk is there. We need to adapt internally, first of all, that the risk is there. It's not optional. It's there. So adding to that, I would say that starting from specific departments, they need to ensure that they do have real-time monitoring. They do have some kind of AI alerts to ensure that we are notified internally about the volatility. We need to take specific steps to ensure that we keep the broker safe when it comes to volatile times. That being said, of course, this idea needs to be communicated to the clients as well, to understand that volatility will be an opportunity if it's managed in a correct structure. And that can be done with different type of scalable leverages or some kind of reporting system for the clients to understand where is the opportunity more than the risk.
So Fadi, my follow-up question to your answer was that I believe you said volatility creates opportunity if it's controlled properly. Can you elaborate on that more, what it means to control it properly, and what you would advise traders to do in an environment that's highly volatile?
Like Raja mentioned just a few minutes ago about now these days you can see 115-minute candles. It's like jumping 16 to $15, you know. And even a few days back there was like one candle, 15-minute candle, which jumped like around 300 or 400 pips.
Yeah.
Exactly. So when you see that the market is having that much volatilities, you need to resize your plan of trading. So let's make it simple and give an example. If I always trade based on my money management with let's say one lot standards, when the volatility become that much and ATR is higher, I need to go for less and resize my lot standards based on the volatility in the market. And it's not every day, but like we said, now these days, especially in 2025, the volatility we face in gold, talking about gold, we never saw that before. 15 to $20 per day, it was like, oh my God, that's huge. Now we can see $100 pretty easy. And even 150 in 24 hours, up and down. So you need to control it by adopting new plans. You know, you cannot stuck with the same plan for every single day or every single month during the news, outside the news, or regardless, or whatever is happening now as the geopolitical impact. So always review your plan based on the volatility of the markets, what's happening around you in the world, and you will be safe.
So Lee, do you advise brokers? You provide services for brokers? In that vein, how are you advising brokers in a more volatile environment?
So first and foremost, we can't officially advise people, but we do work with a lot of brokers and understanding their risk, understanding and managing it. And I think the same things I tell to brokers are applicable to traders here, which is first and foremost, understand what your strategy is. For a trader, it's I want to make money. For a broker, it's how can I safely and securely support all of these clients, support all of these positions, but also make sure that I'm making money, they're making money, and that I can honor payouts. So the risk becomes very different because what you're looking for is how am I going to manage all of these client positions? How am I going to manage when the market's moving very one way? How am I going to manage essentially the risk that I'm holding on the book? So if I'm internalizing any of the flow, then that flow is not automatically profit for you as a broker, that is actually risk that you're taking. So the larger the net open position, the market doing what it's been doing, that can turn into a very real loss very quickly. And this is something that is also applicable to traders. You have positions and the market can move, and those positions might become very large loss positions, even though on a regular market and a regular model that you have, it works very well. So I'd recommend people to understand what level of risk are you willing to run, and really look at yourself as a trader, as a business, or as a brokerage. What is my single one-side net open position I'm willing to do? And I can calculate that looking at historical moves that can happen. If such a move happened, how would that affect my P&L? Do I have the losses to absorb it? Am I willing to make sure that I have a cash buffer large enough to have that? If the answer is that I don't want to have a large cash buffer and I'd much rather have lots of small positions that I get in and out of, then that's a different kind of trading style to if I want to have, like a large overnight position because I think the market's moving one way. I'd also recommend specifically for traders to maybe look at deleveraging or creating smaller lot sizes for those situations, because that way they can deal with it in a much more sensible way. But also, a lot of the times people trade 9 to 5, but the markets will be trading longer. We also do crypto over here in my shop, so that's a 24/7 market. So really understanding that you want to be operating not within, I'm so close to a stop out. You want to be moving away from that. So, operating within 20% as opposed to operating within 70% becomes a much more sensible position to be in, because you don't want something to happen overnight in the market when you're not looking and suddenly wipe you out, close your positions. So it's having that understanding and modeling that risk. It's not impossible to do, it's quite easy to do, but once you start looking at not just the profit that you can make, but also the risk that you're taking onto the book, and you start looking at at it from a risk perspective, which is what banks will be doing, it's what hedge funds will be doing. They'll be looking at what kind of risk am I holding on the book, what risk am I exposing myself to, vis-a-vis the profit, because of course if you're always focusing on higher leverage product and having those positions, you're kind of focusing only on the profit that you can make, not on the risk that you're actually intrinsically holding onto the book. And that's something that once you model out, you become far more adaptable and far more resilient as a trader or a brokerage.
I mean, that's really good advice. Now, we're hearing a lot about how, and very sensibly, how brokers are taking initiatives to protect themselves during this increased volatility environment. Now, Raja, what kind of tools are you providing to customers so that they can protect themselves in this higher volatility environment?
So basically what we've done is we introduced a product called Magic Keys, right? So which means is like traders have a handheld device where they can manage risk with the press of a button. Because the thing is, whenever you're trading with a mouse and your position is, let's say, going in drawdown, what's going to happen is as you move your mouse towards that close button, you can start to think, should I let it run? Should I let it go a little bit more, draw down and profit? What should I do, right? But when you have a thing, you press that button, it just happens right and in there. One more tool we developed is called the MP5 simulator, right? There's nothing like that that exists. So what happens is you can simulate the market as it's being, as like, in like a real-time event, right? So whatever news that happened in the past, no matter whatever, like, flashes happen, you can replay that in real time and to see that, okay, how the spreads were widened at that time, like, what happened with the moves, what news were present at that time. Because let's be honest, whenever we have news events like NFP, FOMC, retail sales data, CPI, or any emergency, or like, let's say if Trump says something, right? We don't know what he's going to say on a Monday or Tuesday, but we do know what he said a year ago or in 2018. So traders can use these tools to replay those market dynamics and to see that, okay, if this was supposed to happen again, what will I do at that same time? So I think this is something very important, because the thing is, whenever a trader takes a trade, they forget about that trade. And then they move on to the next trade or they move on to the next day. So my advice has always been that whatever trade you're taking, look over that trade. See what happened, whether it was a loss, whether it was a win. Because I remember when I was young, whenever I would come home, my parents would say, whatever you studied in school today, revise that at home, right? And it's the same thing. We're grown-ups, but when it comes towards trading, we're grown-up kids. Like we don't take accountability to that. So it's very important, whenever you end your day, look to see what happened and what can you learn from that.
I think that's very, very good advice. I think, as you said, it seems like these are events that have never happened before, but at some point in time, they have happened before, like the US government shutdown, like, not necessarily like COVID, but, other scenarios. So that's very sensible advice. Now, Marios, in terms of the customers that you have, do you see them thriving more from this volatility and adapting quickly, or do you see them really falling behind and struggling in this environment?
It can go both ways. It depends on the time or what asset classes they're going to be trading on to define if they're taking benefit of it or they're falling behind. The important part though here is that we need to ensure that the clients are educated, they know what they're going to be getting into. So we need to ensure that that kind of education / coaching comes before any type of trading. We cannot avoid the fact that market is changing, market is volatile, there's a lot of things that they need to have into consideration. So we need to ensure from our side that the client, before doing anything, does